Welcome, ladies and gentlemen, to another edition of Accounting 101 made simple by J. Ham. Today's topics discuss lesson number 2. We will cover the current asset classification of balance sheet items. Balance sheet items of assets and liabilities are classified as either current or non-current. Current assets are assets the company owns and expects to use within one accounting period, usually 12 months or 1 year, as we discussed in lesson number 1. Examples of current assets are cash, accounts receivable, prepaid expenses, prepaid rent, and inventory. Non-current or long-term assets are assets the company owns that have a lifespan of more than one accounting period or over 12 months or a year. Some examples of non-current or long-term assets are buildings, equipment, furniture, and various types of vehicles. In this lesson, we'll only cover accounts payable and accrued expenses, as I would like the viewers to obtain a strong grasp of the concept of current liabilities, because there's a lot of current liabilities. So current assets in detail: cash and cash equivalents. It's the money that a company has in cash in a bank account, usually a checking or savings account, and other assets that are readily convertible into cash, such as marketable securities, such as commercial paper, which is a short-term debt instrument issued by the company to raise funds for a time period of up to a year, and short-term government bonds, which is a debt-based investment where the company loans money to a government in return for an agreed-upon interest payment back to the company at agreed-upon times. For an example, say if a company has a checking account with Chase Bank with $50,000 in the checking account, and the company also has an investment or a marketable securities account with Charles Schwab with $50,000 in the account. The company would have a total cash and cash equivalents balance of $100,000. The $50,000 in the checking account plus the $50,000 in the investment account. This $100,000 total would be reported in the cash line item of the balance sheet. Accounts receivable, or the acronym for accounts receivable, which is AR, is the money that is owed to the company or person for products sold or services rendered to the customer. Because accounts receivable is expected to be collected within a 12-month period or one accounting period, it is classified as a current asset on the balance sheet of the company. Remember, as we discussed in lesson number 1, accounts receivables are current asset because it's readily convertible into cash. For an example, say if a company is in the business of selling New York Yankee caps and sells a cap to a customer on credit, which is for no money given, for $50. The company would record accounts receivable in the amount of $50. So that $50 would stay in accounts receivable until the customer pays for the cap in cash. So that's how accounts receivable works. Inventory. So inventory is the product or merchandise that a company sells to its customers. Because the company expects to sell the inventory within a 12-month period for cash, the inventory is classified as current on the balance sheet of the company. For an example, say if a company is in the business of selling New York Yankee caps and buys a cap from ABC Wholesale Cap Company for $10. The company would then record inventory in the amount of $10. The company would then mark up or increase the selling price of the cap so that the company can make an actual profit. So when the cap is finally sold to the customer, the company would then reduce the inventory account by $10 through the expense account, which is cost of goods sold or cost of sales, which we will discuss when we go over the income statement and its related elements. Prepaid expenses. Prepaid expenses are future expenses that a company pays in advance. On the balance sheet, prepaid expenses are first recorded as current assets, as the advance paid expenses are expected to be incurred or used within a 12-month period, which is one accounting period. After the benefits of the assets are realized over time, the amount is then recorded in an expense account that goes to the income statement. And we'll discuss that when we go over, of course, the income statement. For an example, if a company pays $100 for office supplies in January, but does not use those office supplies right away, the company would then record prepaid expense in the amount of $100, which would be reported as a current asset on the company's balance sheet. Now, say in March, if the company uses $50 of those office supplies, the company would then record the $50 in an expense account and would also simultaneously, which is at the same time, reduce the prepaid expense account by $50 as well. This process is known as amortization, which will be covered in a subsequent video lesson when we discuss the income statement and its related elements. Prepaid rent. Prepaid rent is rent paid in advance by the tenant. Pretty straightforward. Because the advance payment is expected to be used within a 12-month period, it is classified as a current asset on the company's balance sheet. Usually the prepaid rent is covered within like a 30-day period, but for larger companies, they would have like that situation where it would cover the whole year. So for an example, say if a company leases or rents office space from a landlord on January 1st for $10,000 per month and pays the landlord cash of $10,000 on that day, that $10,000 would be considered prepaid rent until January 31st. So on January 1st, the company would record prepaid rent for $10,000. And they would reduce the prepaid rent account on January 31st via a rent expense account when they actually occupied that space for that amount of time. So that's how prepaid rent works. Problem time. Question number 1. Which statement regarding current and non-current asset and liability accounts is true? A. Accounts receivable is not a current asset account. B. Accounts payable is a current asset account. C. Accounts payable is not a current liability account. Or D. Cash is a current asset account. So as I put as a side note, when solving multiple choice questions, always eliminate the obvious wrong answers to increase your odds of answering the question correctly. So what can we obviously eliminate here? So let's take a look at it. Start with A. Accounts receivable is not a current asset. We know accounts receivable is definitely a current asset because we expect our customers to pay us back for products that we sold to him or her within the 12-month period. So that is incorrect. Moving on to B. Accounts payable is a current asset. Accounts payable is current. It has a current classification, but is not a current asset. It is a current liability. C. Accounts payable is not a current liability. That is incorrect because we know accounts payable is a current liability. And last is cash is D. Cash is a current asset account. And we know, yes, that is correct. Cash is a current asset account. Is always liquid. So we have D. So yes, it would be D. Question 2. Which statement regarding current assets is correct? A. Prepaid expenses is not current assets. B. Cash is not a current asset. C. Inventory is a current asset. Or D. Accounts receivable is not a current asset. So we'll eliminate the obvious. Starting with A. Prepaid expenses are not current assets. No, we know that prepaid expenses are expenses that the company has paid in advance that expects to be utilized within a 12-month period. So it is a current asset. So we can rule A out. Cash is not a current asset. We know that cash is the most liquid current asset on the face of the earth. So cash is definitely a current asset. So we could eliminate B. Inventory is a current asset. Ding, 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 ding. Inventory is a current asset. Inventory is a current asset because it is products that we sell to customers that can be readily converted into cash within a 12-month period. We don't even need to go to D because C, we came across the correct answer. So we'll move on to the next question. Question 3. If you moved into an apartment on March 1st and paid the landlord $1,000 in cash, how much money would you have in your prepaid rent account on March 1st? A, $0, B, $1,000, C, $500, or D, $2,000. So what did we talk about? What is prepaid rent? You're paying rent in advance. So if you moved into your apartment on March 1st and you gave the landlord $1,000 to live there until March 31st, that landlord owes you that space until the end of the month. That's an asset. That's considered an asset because you're paying the March 2nd rent through the March 31st rent in advance. So that's prepaid rent. So the answer would be B, $1,000. Question 4. What are the future expenses that a company pays in advance? A, inventory. B, accounts receivable. C, cash. D, prepaid expenses. So we can eliminate the obvious. What are future expenses? We know it's not inventory, A. We could rule that out. We know that it's not AR or accounts receivable, and we can rule that out as well. And we know that that definitely is not C, cash, so we know that future expenses are prepaid expenses. Question 5. If a company purchases office supplies for $1,000 on January 1st, but does not use those office supplies until June, what would the company record on January 1st? Accounts receivable for $1,000, A. B, cash for $1,000, C, prepaid expenses for $1,000, or D, prepaid expenses for $500. So what did we talk about? If they're recording it on the 1st, if they paid for those office supplies on the 1st and they haven't used it yet, all of that money is going to go into the prepaid expense account. So it's answer C. Question 6. Which of the following represents the product or merchandise that a company sells to its customers? A, cash. B, accounts receivable. C, prepaid rent. Or D, inventory. So we could eliminate the obvious. Which of the following represents the product? Is cash a product? No. Is accounts receivable a product? No. Is prepaid rent a product? No. Is inventory a product? Yes, it is a product or merchandise that a company sells to its customers for money, for cash. So we know that the answer to the question is D, inventory. Question number 7. If a company expects to convert an asset into cash within a 12-month period, what balance sheet classification would the company use? A, non-current. B, long-term. C, permanent. Or D, current. Remember, when solving the multiple choice questions, always eliminate the obvious wrong answers to increase your odds of answering the question correctly. So we have A, non-current. No, because we know that non-current means you're converting into asset in a period that's greater than 12 months, not within 12 months, right? Long-term, B. That's the same as saying A, non-current. Non-current and long-term, they're interchangeable. That's saying the same thing. So if non-current is wrong, then long-term is going to be wrong too. C, permanent. It's the same as long-term. It's the same as non-current. So we would say D. D is current. And that's the correct answer to the question. In the next video lesson, which is lesson number 3, we will cover the following topic: non-current assets on the balance sheet. Ladies and gentlemen, if you like my work, please hit the like button on this video. Please subscribe to this channel, share this video on all your social media, and please sign up to become a Patreon member. May God bless you, and see you in the next video.